The final financial statement to talk about in this series of videos is the statement of cash flows. What does this statement show us? How does it help us? The idea here, or the basic premise, is it's possible for you to have positive, healthy net income, but not have enough cash to pay your bills. There is a difference between the way accounting creates profit through its accruals and its debits and credits. That's different than the actual cash inflow and outflow. So what we want is a statement that will help us identify the actual cash that's created in the company. Again, in the end, you cannot spend profit. You can only spend cash. So that is the mechanism for us to evaluate how well a company really has done when we look at the net amount of cash that's been created. So again, it provides information about cash inflows and outflows. It's a very important tool, right? And essentially, it's the one place where you can go to answer some specific questions about what management is doing in the company and how they're performing. So this is just a subset of a cash flow statement. But let's look at the three things that we learn. Net cash from operating activities. How much cash is generated from running this company? And this is actually the Coors company. So from making beer and selling beer to the public, right? How much money do they create from that business? And you can see here it's fairly steady. 2006 was very big, but essentially they have positive amounts of cash created every year from doing the business that they're doing, right? So they're creating cash from their business. Now, we also have some investing that goes on. They are buying and selling plant and equipment. They are buying and selling companies, right? They could be purchasing partnerships or interests in other companies themselves. As you can see across the board, these numbers typically are negative, which means they are spending money to expand operations, right? Is that good or bad? Well, if they buy good, profitable projects or assets, then it's good. If not, obviously it's bad. What about the financing choices that they make? If these numbers are negative, it means cash is going out the door. They're buying, they're paying dividends, they're buying back common stock, they're paying off debt early, or they're making payments on interest. And as you can see across board, sometimes it's negative, sometimes it's positive. So it appears that there's more cash going out the door than in the door from financing, which essentially means that the company has found a way to buy these assets, right, without incurring outside financing, right? So they're paying off their debts. They're paying dividends to their shareholders. All those things are happening. So the net change, again, we would like this number to be positive every year, but if from time to time, if the net is negative, that's not a terrible thing for the company. It could just be a function of the strategic plan of the company. So again, we need to start with a balance sheet. We need to kind of reorder the information on this balance sheet so we can look at changes from time to time. So we would want to look at 2 consecutive balance sheets and calculate the difference between the line items on the balance sheet. So we would subtract all the items on the balance sheet from this year. We would subtract that from the balances from last year. This would then tell us whether or not the cash was an inflow or outflow. So typically, if the assets are declining, that means that we were selling off assets, that we were generating cash. If the assets are increasing, that means we're buying things, we're increasing the amount of cash that's being spent to expand operations. So again, the inflows and outflows are ultimately going to be a picture of how the company is utilizing and making decisions about cash flow. So again, there are four parts of this statement. We need to understand, where did the cash start? Where did it end? The difference between those two come from the three basic decisions about financial management. How does the company operate? How does the company invest in its assets? And how does it finance its assets? So again, from the cash perspective, we're talking about highly liquid pieces, right? They're short-term marketable securities. Sometimes they're referred to as cash equivalents. But essentially this, if you were to look at the checkbook, and if you were to look at their short-term investments, add those two things together, that is the piece that we're talking about as far as cash. Again, the operating activities. We are providing products and services to the public. What is the cash effect of making those transactions? And again, I would add, this is the most important line item. If you can't make money, if you can't make cash, net cash, from the business that you're in, you should get out of business. The investing activities, again, just to review, we're buying and selling securities. Now, these aren't the short-term securities. These are things like maybe the stocks of other companies. It's the buying and selling of productive assets, right? Plant and equipment, right? All of these things are referred to as these investing activities. And of course, the financing activities are just the borrowing from creditors and repaying back, returning cash in one form or another to the shareholders of the company. So again, the statement of cash flows is very important because it gives us a picture of the three primary decisions that management makes, right? We want to help it. We want to figure out, do they have an ability to generate cash flows in the future? Do we have the capacity to meet our obligations on the short-term side? What are our future financing needs? Are we successful in managing our assets, in particular, our plant and equipment? And then, of course, in the end, what is the effectiveness and the efficiency of our financing? How do these things all work together to create the cash of the company? So it's possible, again, for a company to be highly profitable, but not be able to pay dividends, not be able to replace old assets or buy new assets, not be able to service debt, and ultimately to go bankrupt. How is that possible? How can you be profitable, but in the end go bankrupt? The end question is, the end statement is, it's cash, right? If you have no cash, you cannot run a business. So the ongoing operations of the company, again, it depends on the success of generating cash from the business, right? We need cash to satisfy creditors and investors. Temporary shortfalls are okay. We can typically borrow to cover temporary shortfalls, but in the end, we have to generate cash flow for the company. And finally, here we have just some things that analysts are concerned about, right? They're concerned about the success or failure of the company in generating cash flow from operations. Analysts watch this number very closely, right? They want to know what is the cause of this positive or negative cash flows. What's the magnitude, right? Does it seem to change dramatically from year to year? I think in general, what you would hope is that the operating cash flows of the company, hopefully they increase from time to time, that there is an upward trend in the cash flow that's generated from our business. So again, that is the basics of the statement of financial, of the cash flow statement of a company. So hopefully these videos about statements were useful. I would suggest that you get an annual report and find the financial statements and identify the line items and the things that we've discussed so far. See you in the next video.